Hello and welcome to this edition of Money's Best Friend with me, Vivek Law. Stock markets continue to remain volatile, but there is no need to worry. One way to get around this uncertainty in the stock markets is to diversify your portfolio. In this episode of Money's Best Friend, we will tell you how to diversify your portfolio and how to invest properly. Joining me now is Anil Rego, who's the founder and CEO at Right Horizon. He's a well-known certified financial planner. Thanks very much, Anil, for joining me here on the show. It's been quite tough, isn't it, for investors? I'm sure a lot of your clients have been calling you, wanting to know what to do now with the markets having fallen the way they have. And while we've had some stability, but they still remain volatile, isn't it? What are you telling your clients to do right now?
You know, I believe that volatility is an investor's best friend, and we follow a bit of a contrarian style. And you know, I love volatility because it helps enhance returns. But the point is, are you positioned for that volatility at that point of time? So what investors need to do at this point is go back and relook at their portfolios. And if they have not already booked some profits, you need to first of all see, are you in, let's say, stocks which are, you know, momentum stocks which could, you know, fall very sharply. I think it's important to enhance the quality of your portfolio. Again, on the overall look at how diversified are you? You've completely into equities, and if so, maybe you need to have some options like, let's say, debt funds or even right now the tax-free bonds, etc., which help counterbalance the volatility. And in summary, I think if one is a disciplined investor, he wouldn't get carried away when markets are high and go and invest at that point. And at the same time, it's very important on the downside, you know, not to panic because you know, markets will, you know, take care of themselves. And if you have a systematic style of investing and look at a long term, I think you'll definitely do well.
It's quite interesting, Anil, that you use the word that you love volatility. Can you explain why do you love volatility?
Let me give you an example, you know, of what we did recently. We found that, let's say, mid caps were running a little ahead of, you know, valuations, and so we went back and did a profit booking, including on the mutual funds where there were mid cap funds. And today, that's actually the money which is getting in on a systematic basis, and it will actually enhance now the returns of the portfolio. So we are very happy. And if one is disciplined in that way and see, yes, markets are doing well, you know, our valuations too high when everybody is, you know, running after the stocks and the momentum stocks, and mid-cap portfolio are doing extremely well, that's the time to, you know, actually watch out and see, you know, is this a time for me to de-risk, and vice versa. So right now, you know, one has the cash to be able to deploy it, and actually, you know, that will enhance returns.
You talked a little earlier, Anil, about the tax-free bonds that are, you know, now hitting the market. Can you tell us a little about that? And as far as the debt side of a portfolio is concerned, do you think it makes sense? Do they fare better, according to you, as compared to, say, a standard bank FD, which is where most of us end up putting our money in?
Yes, I think tax-free bonds actually make a lot of sense for two reasons. One is that in a declining interest rate scenario, tax-free bonds can actually, you know, give you a good capital gain as well. And the second reason is that especially for fixed deposit type of investors, they are tax inefficient avenues, and a tax-free bond will actually almost give you a 10% type of return if you were actually invested in a bank FD, which means if you are in the 30% bracket, that is. So if you got 10% in a bank, after 30% you're only left with 7. So today you're getting more than 10% yield through these tax-free bonds. So it's a definitely a good option to look at, even including investors who are little apprehensive of looking at income funds for their volatility, and they don't mind looking at, you know, tax-free bonds. They are also a good option. What is good about the tax-free bonds is, even though they are long-term and they are ideally 10 years plus, they also have a listing, and that gives them liquidity, and you can also sell it even before, you know, the due date, and that makes it an interesting option for most investors.
All right, Anil Rego, thank you very much for joining us here on Money's Best Friend. Appreciate you taking your time out. All right, it's time now to wrap up this edition of Money's Best Friend. If you have any query related to equity, mutual funds, insurance, real estate, gold, then do write in to us at moneysbestfriend@aajtak.com. Goodbye for now and have a nice weekend.